Andrew, thank you for joining us. What is in fact your first of these monthly vodcasts. During last month, you took on kind of additional responsibilities for running the Harmony funds on a day-to-day basis, implementing the team's policy, and so now you find yourself in the hot seat here today, so to speak. As such, to kick us off, can you talk to the performance of the funds, the Harmony range, last month?
Sure, thanks for the introduction, Richard. The Harmony funds performed well last month.
Okay.
Returns across the board were positive. They ranged from a low of plus 0.4% for the Aussie Dollar Growth Fund through to a high of 2.2% gain for the Sterling Growth Fund. As one would expect in this sort of market environment, the growth profiles outperformed the balance profiles, given the larger equity component and rising equity markets over the period. It's not to be taken for granted though, this year at least, given that if you remember back to the start of the year, bonds were doing very well when equities were
Absolutely.
fairly weak. By the end of June, equities had broadly caught up with bond markets again, with both showing positive gains for the year. And then since the end of June, the equities have extended their lead over fixed income. So that profile of the growth portfolio is outperforming balanced is consistent over 1, 3, 6 months, year to date, etc. Indeed, returns over short, medium and long periods for the Harmony funds are positive and reasonably satisfactory from my point of view.
Okay.
And an additional factor to note for the performance in August was the effect of currencies. The US dollar was very strong. On a trade-weighted basis, I think it had its strongest month since March 2013, with particular strength versus other majors such as sterling, euro and yen.
Yeah.
Certain commodity-linked currencies were actually stronger than the dollar over the period. That was a particular benefit for emerging market investments.
Okay.
With the likes of Brazil and South Africa seeing their currency strengthen versus the dollar, and even more so versus weaker currencies like the sterling. The implications for the Harmony portfolios was that the sterling and euro profiles in particular benefited a lot from the global components, like investing in the US, Asia, etc. It had this tailwind from currency appreciation of the dollar, hence taking them towards the top end of the returns over the month for the Harmony funds.
Okay, thank you. Let's look back then at August and look at some of the key themes that would have been affecting markets.
Okay. August is, I guess, traditionally expected to be a quiet month given the summer holidays in Europe, etc. It wasn't so much this month. There's a lot of events going on in the background from a geopolitical point of view, central bank activity, etc. It's been going on for several months and continued into August and continued to drive a certain amount of volatility across asset classes. The net outcome for the month though was strong, positive, well, reasonable to strong returns for most asset classes across equity and fixed income, something that we're becoming slightly accustomed to this year, I suppose. In terms of particularly notable events, the S&P 500 in the US passed through the 2,000 mark for the first time ever. Somewhat strangely, in the same month, the yield on 10-year German government bonds, Bunds, fell below 1% for the first time as well. It's somewhat unusual to be seeing those things happening at the same time, given the negative correlation you would normally expect from equity and bond markets. The yield falls in Bunds was reflective of a strong outing over the month for most government bond investments across the US, Europe, UK, etc. In the UK, gilts were up 3.5% or so. An incredibly strong return, really, when you consider the starting point for the month in terms of yields. You would have thought the upside is fairly limited, and indeed it is, but August just goes to show that there are still some positive returns to be made from this area. Thinking about equity markets on a global basis, developed market equities were up around 2.3% in US dollar terms for the month. That broadly matched the return for emerging market equities over the period. Infrastructure and listed real estate, as kind of specific subsectors that the Harmony funds are exposed to, underperformed slightly versus broader developed market equities, but still remain probably 7 or 8% ahead year to date or so, following outperformance in previous months. In terms of the regional spread of returns over the month, the most notable returns came from the US, which outperformed significantly. In local currency terms, even more so for foreign investors who maybe benefited from the currency strength as well. And that was a very broad-based rise, with most sectors increasing largely in tandem with each other over the month. Japan, meanwhile, was the laggard. It was one of the few markets that actually posted a negative absolute return over the month. And maybe just to add, emerging markets, as I mentioned, performed well, with a similar return to developed market equities, plus 2 and a bit %, marginally ahead for the month. That was the standout performer for the month was Brazil. But just thinking about the performance in the context of recent months as well, it's worth noting that that's the 4th consecutive month of emerging markets outperforming developed markets now.
Interesting.
And indeed the fourth month of positive absolute returns in local currency terms.
That's very
that
interesting.
asset class, despite obviously a difficult backdrop
Yeah.
for emerging markets, plenty of risks out there, but performance has been very poor for a number of years, at least on a relative basis. It just goes to show that even in the face of difficult macro environments, valuations matter and returns can still be good.
Absolutely right. Taking that then, those themes that we saw last month, how did they translate into performance for the Harmony fund range?
Sure. Okay. Well, first thing to note is the underlying holdings across all the Harmony portfolios, barring a couple, they all delivered positive returns in their base currencies, which is a good month. It's pleasing to see. Maybe just thinking about it from an asset allocation point of view to begin with, we benefited from marginal overweights essentially versus our strategic long-term allocations within equities.
Yep.
So we've got most of our risk exposure in both the balanced and growth profiles is really in equities, be that in regional equities, global equities, infrastructure, listed real estate, etc. They all did well. I guess a missed opportunity for us was on the fixed income side of things. We remain underweight fixed income. We have low allocations there, and we have minimal to no exposure to a lot of the areas that did well over the month. So no government bonds, no high yield, etc. So in contrast to previous months in the year when it's been the same case, when these long duration assets have performed well, in previous months what we hold instead, emerging market bonds, convertible bonds and the like, have compensated and offset that and broadly matched the returns of areas like government bonds. That wasn't the case in August. The holdings that we had did provide small positive returns, but they couldn't keep up with the magnitude of returns that government bonds delivered over the month, which ultimately we don't think is repeatable. We remain very confident in our long-term positioning, but in the short term we can have months like this.
Absolutely. Sorry. A quick note maybe on some of your manager selection themes. I know something that you personally take a lot of pride in the depth of that manager research. Were there any notable funds to pick out there?
The manager selection had probably a smaller impact on returns in August than maybe in previous months. It may have been the case. A lot of our managers across the equity and fixed income asset classes performed somewhat in line with their benchmarks or marginally ahead or behind. It didn't overall have a big net effect, except for in a couple of key areas, namely UK equity, where in fact all of our UK equity managers outperformed their benchmark, most notably Lindsell Train, who were up 4.something%. In sterling terms, a great month for them. And also in the Asian equity space, where again all of our managers outperformed over the month. So very pleasing outcomes there, and contributed a decent amount to absolute returns over the period. The one notable disappointment was on the Japan side of things, where our manager, Polar Japan, underperformed, unfortunately, in what was also a slightly negative market for the month. That manager is essentially leveraged into the reflation story in Japan, in terms of being aligned with those areas that should benefit from Abe's policies, be it from a monetary policy point of view, new fiscal policy, and other reforms that should benefit certain areas of the market. And we still believe that will be the case over the medium to long run. The market has lost some confidence in that, particularly this year, and notably in August as well. So that's led to poor returns, but we believe that will come back. It's a short-term disappointment.
Okay.
To be expected.
Yeah, absolutely. A comment next on where the funds are positioned today. Possibly also a comment on any changes you may have elected to make last month.
Okay. No changes were made over the course of the month. We didn't feel the need to. Our asset allocation views didn't change substantially. Valuations didn't change substantially, and we remain very happy with all our existing managers. As mentioned before, a lot of our risk and where we expect to get return from over the next few years is within the equity portion of the portfolios. But it's important to note that that's a very diversified group within all of the Harmony funds. So we have large allocations to a range of regional managers for the appropriate profile, as well as exposure to global equity managers, global emerging market managers, all across a range of different investment styles, quality, value, and more growth-oriented styles as well. And then also some more specific investments in asset classes such as listed real estate and listed infrastructure as well, which generally represent a very small portion of broader equity indices like, say, the MSCI World, so what we feel are high-quality areas that deserve a larger exposure in investors' portfolios. And then, as alluded to before, we retain fairly low exposure on the fixed income side of things. We do have some exposure. Fixed income is one of the ultimate sources of protection during a crisis, and it's valuable within a portfolio for the diversification benefit you get from that, and that potential protection at times. We are well out of areas like government bonds and, as I mentioned, the longer duration, longer maturity assets, which we feel are very overpriced, and where there is ultimately a lot of risk of capital impairment within those investments. We don't have exposure there. Rather, we're invested in areas like short duration emerging market debt with a specialist manager there. Global and Asian convertible bonds as well is another area. Short duration bond-like, but with ultimately equity upside in there, and a great manager that we believe can add value over and above the asset class. So that gives a reasonably that's the highlights, I guess, to how the Harmony funds are positioned at the moment.
Okay. Finally, then, Andrew, can you give us your outlook? What do you see coming up in markets?
What do I see coming up? I will stop short of trying to forecast what's coming around the corner, because that's a very difficult thing to do. Kind of over the medium to long term, I suppose, kind of in line with our 5-year asset allocation views, it's probably worthy to note that, well, it won't come as a surprise, we don't see a lot of value in markets at the moment. It's a challenging environment, I think, for all investors, really. We're at a point, we're 5 years into a big equity bull market, at least across most geographies, and so valuations and share prices, etc., are reasonably high. Although, having said that, the base 5 years ago was very depressed, so it stands to reason that returns to at least a fair valuation have been very strong. It's a difficult geopolitical backdrop. At the same time as central banks are at least introducing less loose monetary policy, if not veering on starting to tighten, and that carries with it some risks. Could impact markets in the short term. But it's important to remember that the reasons that such decisions are being taken The economy, for example, in the UK and in the US is generally quite strong. The recovery is taking hold. So, along with a healthy corporate environment at the moment, we think it should remain a reasonably supportive environment for equities, hence our positioning. Fixed income markets is, we've been saying this for quite some time, but we see so little value there across many Western government bond markets. I mean, the real interest rates are negative, and that should really say a lot about the long-run returns that you should expect from these areas. We think our expectation is that rates will be meaningfully higher in 5 years or so in the US, in the UK, etc. It doesn't mean to say that rates are going to shoot up in the next couple of months or so, and there are going to be sudden losses in those asset classes. Rather, it could just be a drift up over a multi-year horizon, which sees subpar to negative returns from those asset classes over that sort of time period. It's an expensive asset class. There's a lot of risk there. So we are going to remain, I think, positioned where we are within the Harmony portfolios of having limited exposure there, rather favouring areas like equities, where although valuations have come up, as I said, on a relative basis, and indeed versus long-term history, they don't look overly expensive. And when opportunities arise from dips, then I think we will be looking to add to equities.
Andrew, thank you very much for sharing your insights today. I'll finally note, as ever, if clients have any questions about the content of today's podcast, they should drop us a line. Other than that, thank you very much for joining us.
Okay, thank you.